Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go until the closing bell, and stocks are turning higher here after initially falling earlier in the day. The very own Jared Blickery is standing by with all the headlines. Jared.
Thank you, Josh. Nice to begin the week with a little bit of strength here, especially with all the volatility we saw last week, and we'll get into the VIX in just a second. For now, here's the Dow Jones Industrial Average up not even 100 points, or about 18 basis points. A lot of choppy action today. Nevertheless, green is green. NASDAQ Composite up about 1/3%, and the S&P 500, that has been both red and green, very similar chart, and it's in the green for about 0.3%. We'll also take a check of the small caps. Russell 2000 has climbed into positive territory, up a little bit more than the S&P, kind of on par with the NASDAQ, which we just looked at. And I want to get a quick check of the bond market, which is pretty quiet here. We did have a holiday yesterday, but here's the 30-year T-bond yield. That is down 1 basis point to 4.69%, and the 10-year is just about break even, 4.06%. Meanwhile, the US dollar index up 0.25%. Now here are the large cap sectors, and leading is financials. Haven't seen them lead in a while. Second place is real estate. Then we got industrials and tech. All of four of those are outperforming, so kind of an eclectic mix at the top there. But to the downside, we got a few losers down more than 1%. That would be staples, energy, and materials. So a mix of a little defensive and a little cyclical in there as well. Here's the NASDAQ 100. You can see the mega caps, some of them doing pretty well, and NVIDIA up nearly 2%. Apple coming back nicely after a steep drop last week, 3.76% to the upside. Broadcom up more than 2, Amazon up more than 1. Meanwhile, Tesla down more than 1, Microsoft and Alphabet in the same boat, and Walmart here, $1 trillion club, well, probably flirting with that right now. It's down about 4%. And we've been tracking the story of semiconductors versus software, and today we're seeing a continuation of the strength that we've seen in semiconductors this year, led by the behemoth there, NVIDIA. And here's software. Opposite story. You can see Oracle down 4%, a lot of red here. Intuit down almost 5, CrowdStrike over 4, Salesforce over 3, and Snowflake nearly 4%. So a tale of two markets. And let's take a look at the Dow as well. And aside from the mega caps, which we covered, we did talk about that financial strength. So we're seeing that in JP Morgan, that's up 1.5%. Goldman Sachs up a little bit less than that, and American Express up 2. And also seeing some strength in industrials. Although GE is no longer in the Dow, maybe it's going to be again someday. That has been leading aerospace and defense higher. We also got Honeywell up 1%, and it looks like Nike. I'll throw that in there. That's up 2%, Josh.
All right, thank you, Jared. Well, Wall Street looking to regain its footing as stocks come off yet another losing week. And joining me now is David Volpe, Emerald Advisors Deputy Chief Investment Officer and Portfolio Manager. David, always good to see you. Maybe start higher level, Dave. I'm just curious how you would sort of broadly describe the market mood we find ourselves in right now, Dave. Just in terms of the market action, investor sentiment, how would you characterize it?
Well, Josh, I'd say it's cautious at this point in time. After the last 5 weeks, you've had the NASDAQ down 5 weeks in a row. You've seen a big sector rotation away from, certainly software into hardware, into some of the safer areas of the market, into areas such as materials and energy that really people perceive as not being able to be supplanted by AI. So again, caution, but at the same time, there's certain areas of the market that are really, really working. Maybe not so much on the mega caps, but certainly the rest of the market, there are areas that have been strong.
What's on that theme, David? I guess I'm curious, what are the sectors that you think, okay, against that backdrop, in that environment you described, what are the sectors you think these are relatively best positioned?
Josh, I like to say that you stay with the date that you brought to the dance. And for us, that means aerospace, that means AI infrastructure. That means areas like healthcare. We're really strong in healthcare, so a lot of the growthier names are acquisition candidates. Material names, energy names, but again, AI infrastructure in particular, whether it's power, connectivity, other areas in terms of cooling in AI. So as long as these names, you have rumors, you have stories, but it's the same as your date. You listen to those stories. Maybe you're not going to go home with that date. In this case, you got to see through that a little bit, and that's what we've done.
Dave, what about those mega cap tech names? They've been, I guess wobbly is one way to put it, David.
Yeah.
What are your thoughts there?
Well, when you're going to spend $700 billion, let me say that again, $700 billion, that's not so good for your free cash flow. If you're the mega cap, you've seen free cash flow for those names literally go off a cliff. At the same time, some of the small mid-cap names that are beneficiaries, you think about it, AI, capex, hyperscaler capex, is revenue to a lot of small and mid-cap names that are the beneficiaries of this, as well as the broader economy. So, again, some of the larger names, a little bit challenged in terms of just changing their whole business model, which has been cash generation and growth, now towards future growth, but using a lot of cash. So again, other areas of the market that really can be beneficiaries of this.
I'm interested what your clients say to that, David. I mean, listen, they've seen those mega cap tech names work for a long time. What's the kind of feedback you get from clients about that?
Well, they've been appreciative of our products and that we've been underweight a lot of these names, sans NVIDIA, for the better part of 3 years, and still had pretty good performance, and particularly last year, fantastic performance, even being underweight the mega caps, because if you're a stock picker, you're able to find names. There's been a lot of dispersion in the market, and finally, some of the small and mid cap names are seeing earnings growth. So apart from just obviously the strong economy, steepening yield curve, but most importantly, the stock picker, we believe earnings growth drives stock prices. You're seeing earnings growth broaden out into some of those small and mid caps. And this year, small caps should have greater earnings growth than some of the large caps. That's like it's like nitro to some of these names.
Speaking of the dollar, David, sounds like you say here you think dollar weakness persists. How come, David? And if you're right, okay, how should investors think through that dynamic? Who wins and loses?
Well, dollar weakness is good for companies that are exporting outside the U.S. They're good for, obviously, external markets, so emerging markets or international small cap or the like. But at the same time, you've got an administration that, absent Besant, has basically been pushing and tamping down on that dollar just to benefit U.S. manufacturing. And then when you've got the trade policies that you've had, it's no surprise that you've had a weak dollar, and likelihood is that persists.
You mentioned here how treasuries, David, are firming. What signal do you think that's sending investors?
Well, that's beneficial. As long as you've got a steepening yield curve with the short end being relatively lower and then a steepening into the long end, that's certainly good for banks. So you talked earlier about financials doing well. We continue to see that. And that's certainly good for, we talked about before, small and mid caps, that steepening yield curve, that the tight spreads. Spreads have stayed really narrow. Those are really good things for particularly small and mid cap stocks.
Do you stay U.S. focused, David, or do you also look for opportunities overseas?
We do look for opportunities overseas. An institution we just partnered with has international small cap, emerging market small cap. So it's an area of increased focus for us. And certainly, as we saw last year, it was an area that really did well. And I would think it could continue to do well, given its underperformance for literally a good part of the last decade.
Finally, Dave, I'm just curious how the Fed sort of fits into your narrative there. What's the story? What's your base case for cuts in 2026, David? Does the market need cuts, in your opinion, to move higher?
Josh, I don't think it really needs cuts. I think you'll see a couple of cuts, 2, maybe 3. But let's be honest. You go into May, you get the confirmation. If assuming Warsh is confirmed, it always happens. There's a test of that new chairman. So I would expect that to be the case. And that's going to create a lot of volatility. But it could be a different type of Fed, obviously. But that should be beneficial to the market. And I think the market will see through it. I think they wanted an independent nominee. I think that's what they've got. And so I see the Fed as certainly not an entity that's going to constrain the market and something the market can kind of look through and look towards that earnings growth. Earnings growth based on productivity, based on just the overall strength of the economy, based on deregulation. I can go on and on in terms of why that earnings growth and the economy should do so well. And I think they'll see a lot through the Fed in terms of that.
David, great to have you on the show. Thank you.
Thank you, Josh.
Coming up, we hone in on the copper mining market with the CFO of BHP. That's next on Market Domination. Commodity markets seeing cautious positioning ahead of key economic data this week, and Yahoo Finance's Inez Ferre joins now with a closer look at the trading action. Inez.
Josh, we've been seeing a sell-off when it comes to precious metals. If you take a look at gold, it's down 3% right now. That's a significant fall for gold, down around 4,900 per ounce. And keep in mind that part of this has to do with thin liquidity, the Chinese New Year that is in effect, that basically has the Asian markets that are closed. And here's where you can tell, or where you notice the absence of Asian buyers, because they have been so instrumental when it comes to the rally that we've seen in precious metals. But make no mistake, the bank strategists are still saying that the gold trade is still intact. In part, this is because of central bank buying, lower interest rates, and an easing dollar trend. When it comes to silver, we have seen a sell-off even more significant in silver. Silver has been the more volatile of these two trades, down more than 5%. Strategists are not as bullish when it comes to silver necessarily, but gold certainly, they do see prices climbing this year. Then just taking a look at what's happening with crude oil, we have seen crude oil down 0.8% for WTI, Brent down 0.6%, so around 67, just above 67 per barrel. This in part has to do with the U.S. and Iran talks, which have been progressing. So this has been putting pressure on prices. For all the talk about military action against Iran, et cetera, analysts are saying, look, this is a year of midterm elections, and the Trump administration is going to want to keep energy prices low, especially going into the midterms. Josh?
All right, Nez. Thank you. Appreciate it. Well, the world's largest miner is seeing a boon in copper, with the red metal now accounting for over half of the company's core earnings. It comes after the company's multi-year pivot toward increasing metals production. BHP reported a 22% increase in first half profit growth, which beat analyst expectations. BHP's Chief Financial Officer, Vandita Pant, joins me now. Vandita, great to see you. So let's dig right into these results, Vandita, because this was a milestone here. Copper accounted for more than half of your profit. So I guess to begin, Vandita, just walk us through what that means for the company financially, strategically. Should we think of, Vandita, of BHP as really now a copper company more than iron ore?
So Josh, great to be here. And the way you should think about this is we are executing exactly like we said we would, growing copper in last 3 years by 30 odd percent. And if you look at our portfolio, the interesting part is the balanced nature of that. As you just said, quite a milestone for us, with more than 50% of earnings this half coming from copper. But equally, we have a very strong, world's best margin iron ore business as well. And very soon, potash to come in. So the model for BHP includes very good performance in copper. In fact, for this year and next year, we are increasing our guidance for copper production, which is a fantastic time to do so with the stronger copper prices, while continuing to run the lowest cost iron ore business in the world, whereby we make $10 per ton more cash flow compared to our nearest competitor. And this operational performance coming through with record production and shipment out of iron ore, but equally in copper, like I mentioned, increasing our guidance for this year and next year. Not only that, what we are very excited about is the growth prospects, which are coming through and really maturing our growth pipeline in copper, whereby by 2030s, mid-30s, we are looking for another increase of 30-40% in copper units. So, and all that coming through in, you saw, as you said, in strong financials, with the EBITDA earnings up 25%, dividend at 60% payout, 73 US cents, which is above market expectations.
Vandita, what role is the great AI trade and trend playing in the copper story you're telling?
Quite a bit, and we're very excited about it. But the beauty of copper, Josh, is that it is a ubiquitous demand story for copper. It is needed for our way of life, for economic growth, and now has got this massive copper intensity coming out of energy transition and digitization AIs. We expect copper to grow from where it is to for next 25 years by 70%. And of that, 6% of copper could be just on AI and digitization. While that's the demand story, what is the challenge in the market is that supply is becoming more difficult to get. The projects are big, are difficult, the grades are getting lower. And hence, the demand versus supply dynamics are very strong for a supplier like us, which banks on its reliable performance year in and year out. We are already the largest copper producer in the world and growing into it with from where we are to 2.5 million tons of copper by mid-30s, including the byproducts. So that's a great story for performance today, but also leaning into copper for times to come when copper will be even more attractive commodity across different end users.
So copper is a growth engine, Vandita. What about gold? Gold price is obviously very strong. What does that mean for your earnings, for your cash flow?
Yes, so our copper deposits are such that they have a lot of byproducts, and byproducts are gold, uranium, silver. In fact, in last half, we made around $2 billion just on these byproducts. So that's a fantastic portfolio. And as we grow copper, in Argentina, in US, in Chile, in Australia, our byproducts, that is gold and silver, will also grow. So it's a very attractive portfolio from that perspective. And equally, we continue to look for ways in which we can unlock additional value from our capital base, or if there are parts of our portfolio which are undervalued. And you may have seen, Josh, that we have announced a $4.3 billion silver stream, which essentially means that we get upfront cash for giving up the future production of silver in one of our mines of Antamina in Peru, which was an undervalued part of our portfolio. And we have realized $4.3 billion on that upfront. That, along with $2 billion done in December for our Veo Power agreement in Australia, that is another $6 billion plus capital unlocked, which goes into our capital allocation framework, along with our very strong cash flows from operations, which all then get divvied up for attractive, mature sets of growth options, as I was mentioning, mainly in copper and in potash, and rest of it comes back to the shareholders as well.
Vandita, final question here. I just want to talk about the iron ore business. Reports noting that you are in what's described here, Vandita, as tough negotiations with China's state-owned iron ore buyer. Just bring us up to speed there, Vandita. What's the story there? And for investors, what's the risk that this drags on?
So look, a company of our size, when it is in commercial negotiations, they tend to be tough and they tend to be big. The important issue is that we have been managing through it very well. As you and our investors can see from our half-year results, we had record production and record shipment for iron ore. We continue to be the lowest cost producer of iron ore and had very good price realization as well. Our focus continues to be on making sure that we reliably supply to the customers and equally manage our assets in a productive and flexible way, while utilizing different product placement channels for distribution of products. So I'm sure we can come to a right kind of win-win resolution. But in the meantime, results show that we are managing through it pretty well.
Vandita, great to have you on the show. Appreciate your time. Thank you.
Thanks, Josh.
Coming up, we bring you the top trending tickers on Yahoo Finance. Don't go anywhere. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joining me here for a look at Paramount, Skydance, TripAdvisor, and Snap. We're going to start here with Paramount as Warner Brothers agrees to reopen discussions with the company. So this one, it sounds like, Brooke, okay, Warner Brothers Discovery agrees to reopen negotiations with Paramount Skydance after it proposes raising the bid, right? Netflix, it sounds like, grants the board 7 days to discuss the proposal. So the drama continues.
Yeah, the drama certainly continues. Yeah. We do see Paramount shares rising about more than 5%, as you can see on your screen as you make your way towards the close. But definitely investors optimistic about what exactly this could mean, if exactly Paramount actually could come up with a new, substantial, even sweeter offer. We know that just last week, Paramount put out that $30 per cash offer. Now Warner Brothers saying that there's sort of an informal agreement that they can go up to $31. We also got that ticking fee. They also said that they agreed to pay the $2.8 billion termination fee if they did not go with Netflix. And over the past few months, this saga definitely has picked up. The drama continues for sure. And we continue to see that when the deal between Netflix and Warner Brothers was initially announced back in December. According to Polymarket, the odds that this would happen was about 30%, and now that it's sort of lower to about 22% that Netflix could close the deal with Warner Brothers by year end. And really just the drama around this, it's almost like a movie itself.
Yeah, I've heard some analysts really make the case that the Ellisons, Larry and David, they need this to happen.
Behind Paramount, right.
This is a must-have for Larry and David.
Yeah, and when Paramount thinks about how exactly it sits within this bigger streaming picture, it's like, will their Netflix have more power, or will it ultimately go to Paramount, who, it's important to note, is including the whole entire Warner Brothers Discovery, linear channels as well, whereas the Netflix deal wouldn't include that. So it depends. Right now, Warner Brothers is saying, hey, we still want to go with Netflix, but could they still actually give Paramount a substantial chance here at getting the Warner Brothers film and everything?
Yeah, Larry is worth an estimated $200 billion, so that does help. Wow. That comes in handy.
Just a small drop in the bucket.
Right, now look at TripAdvisor as Starboard ramps up the pressure on the company to create shareholder value. So they deliver this letter. They emphasize, listen, we got some prolonged underperformance here, guys, and that stock is down. It's been shelled. It's down about 40% year over the past 12 months. They announced plans to nominate a majority slate of director candidates for that 2026 annual meeting.
Yeah, year to date, the stock is down about 27% alone. Of course, today you're getting this pop about what exactly this could turn out to be, but you can't help but hear when you hear Starboard value, think about the other players that they've taken a stake in as of late. We do know they took a stake in Pfizer and have since stepped away in late 2025. Also, this reminded me back in August of 2024, right before we got a new CEO at Starbucks. Starboard also took a stake within that company. Also, Macy's, this company, this activist investor has gone after, specifically not for stock reasons, but more so there was that big discussion around its real estate value around Macy's a few years ago. So definitely it's pretty monumental. And this company steps in, that change is likely to happen here.
Yep, popping today about 10%. All right, finally, look at Snap as the Snapchat business launches paid creator subscriptions. So CNBC reporting here, Snap introducing subscription feature. Brooke, it's going to, I guess, allow creators to earn what sounds like recurring income directly from their most engaged fans. So this is Snap, obviously, like looking for ways to, hey, well, let's try to diversify beyond advertising. So paid creator subscriptions.
Yeah, and like TikTok has that creator fund as well. So is it trying to compete with that? Also interesting, maybe field study. I was at a few middle schools in the past week talking to students, and they said that Snapchat is like their #1 form of communication. So still ahead with Gen Alpha there, but at the same exact time, Wall Street largely on the sidelines with this. There is about 35 holds, only 11 buys and 3 sells. Also, really what they're focusing on is these ways in which they're not only going to grow subscribers after losing some, but other forms of monetization. Don't know if you're a Snapchat user yourself, but now you have to pay for storage, which I was pretty upset about, not gonna lie there.
I'm impressed by that, as you say, most analysts are on the sidelines here, like 71%.
Right.
71% of analysts who cover the stock, who are paid to tell you what to do with it, are telling clients you should hold it. Even though this stock, Yikes. Pull up a chart of this stock. It has been shelled. It's down around 40% this year.
56% over the past year,
Right, around 60% over the past 12 months. A lot of times you would see a chart like that and you'd be like, all right, I'll take a flyer on this. Like, the bad news has to be in, but most analysts are like, no thanks.
Well, I will say in recent days, just last week on February 10th, and then also earlier this week, Snapchat was upgraded by both Stifel and Race to Buy at a REIT, if I believe I have that financial firm right. They said that Snap's top line growth is further shifting from its reliance on a subscale ads business to a higher margin, thinking about that subscription income. So definitely some optimism on the street, some turnaround here. But I mean, when they're thinking about how it competes against Meta, how it competes against, up and comer, maybe what TikTok's gonna look like now that it is a private US business, definitely trying to understand how Snapchat sits in that landscape. Maybe this is a turnaround. Maybe this is the bottom.
All right.
I don't know.
Thank you, Brooke. Appreciate it. Shifting gears to Ford now, as the automaker reveals its pursuit of efficiency with the EV business. Yahoo Finance's Praz Sumarian joins us now with the details. So Praz, the story here, they're unveiling this new cheaper EV platform. What do investors need to know?
Yeah, so they spoke about this as being their big pivot, right? They bet big on batteries and bigger EVs, and that sort of went south, right? So the market just wasn't there for those bigger EVs. So they think that cheaper EVs built differently is the way to go for the business. So what does that mean exactly? So simpler, fewer parts, cheaper electrical systems, like the zonal architecture that Rivian uses, things like that, unicasting other processes to make the build simpler and cheaper, right? Also more use of aero. Big gains in aerodynamics means less drag, less energy used, means you can have a smaller battery with the same range. And speaking of batteries, you're going to go with an LFP chemistry, which is it's cheaper, more durable, not as much range, but it's a bit more better for duty cycle. And also you're going to reduce battery weight there because you're going to have more aero cars, lighter cars, and then about the same amount of range. That's the big bet there is efficiency, cheaper components, but also, Josh, is they're going to make it into the first vehicle will be a pickup, a mid-size pickup as a first sort of platform that's going to come out of that, first sort of body style coming out of that platform.
So the first product, Praz, would be this mid-size EV pickup. Do Americans want a mid-size EV pickup?
They certainly want cheaper EVs, right? That was always the big problem. These are too much money. What you're seeing now is in the used market, EVs creeping below $30,000. Sales are actually jumping pretty highly for that because it's just a good deal. Americans, it's affordability issue is the main concern, right? Now, the question you're raising is why didn't Ford use, let's say, a mid-size SUV platform like the Model Y, or even like the RAV4, the most popular vehicles on the planet? I think Ford thinks that, hey, we can lean into our pickup culture. We're known for pickups. Maybe it's a more sexier body style, and I think that's what they want to do with their first new second-gen EV.
So I think you said in your story, Praz, that this mid-size EV pickup, I think you, correct me if I'm wrong, I think I read like 30,000. So at that price point, this product, Praz, is competing against which names, which rivals?
Like I said, you're competing against a lot of used vehicles, right? That's a big issue. But in the world of EVs, brand new EVs, you can get a Model 3 base, a rear-wheel drive for around $37,000. You can get cars like the Chevy Bolt, the new Bolt's coming out. You can also get cars like the Nissan Leaf, right? That's redesigned for this year. These cars are also smaller, compact SUV crossover type vehicles, very popular. I think that with regards to pickup, the only other offering is Slate. That's a new upstart company that supposedly later this year will unveil their modular, another modular EV pickup that you can actually kind of use. You can work on it yourself, like replacing body panels and stuff. You can even make it an SUV by adding a back to it, right? But that'll be around $35,000. So that's sort of the main competition there for Ford. And it's just a big bet on cheaper EVs in general.
All right. Thank you, Praz. Appreciate it.
Thanks.
Dutch Bros planning a big expansion in the years ahead, expecting to open at least 181 stores in 2026 and have 2,029 shops by 2029. Still, shares have fallen more than 30% in the last year amid concerns about slowing demand and higher costs. Dutch Bros CEO Christine Barone joined our very own Julie Hyman and Brooke DePalma this morning to talk about this expansion.
The heart of the Dutch Bros brand is our people. And how we ensure that happens is we grow with our people. And so all of our operators that go into new markets and introduce our brand to new communities, they all started as broistas at Dutch Bros and have been with the brand on average over 7 years. And so that's really how we ensure that we continue to grow this incredible culture as we continue to expand across the country.
Christine, as you're expanding, you're also opening up maybe new types of stores. You experimenting currently with that walk-up location in LA. First question, how's it going? And two, can we expect a walk-up location here in New York?
So we have a great location now in downtown LA. And what allowed us to do that is we launched mobile order last year or the year before. And as we launched mobile order, it really gave us another channel to serve our customers. So when we went down to downtown LA, we still have 2 windows. Our operations work the same as they do with our drive-thrus. Instead of the party in the parking lot, we have a party on the patio. And so it's really working incredibly well. But it's our first shop, so going great. And we'll see where we take it from there.
All right, so Christine, any chance that a New York walk-up is coming anytime soon? And with that being said, how are you thinking about the cost of rent as maybe you do get into these bigger cities?
Yeah, so we're really focused on expanding from a drive-through perspective. We're focused on expanding to contiguous states to ensure that we've got teams ready to go to those states right now. I do think that LA opens other opportunities for us, but we're really focused on our core strategy right now.
Let's also talk about the food strategy a little bit as well, because I know you guys have been expanding more into food. What can you tell us about that? And also that a number of your locations don't accommodate food right now. So are you going to be doing any retrofitting or changing that at all?
Yeah, so as we roll out food, we shared that we were in 300 shops at the end of the year. So we've really been expanding this quite rapidly across our system. It's going incredibly well. And what we learn from our customers is we ask them all the time, what would you like from us? And they shared that, I love your coffee so much. I love your energy drinks, but I'd really love something in the morning to go along with that. And so as we looked at that, this is the number one thing that our customers were asking for. And as we roll it out, they're incredibly happy to see it as it comes.
When you think about the expansion of food itself, there's only a few items that make this up. I believe it's like 2 or 4 hot items alongside what you guys typically had. As you roll out, what are some of the challenges that your employees are up against? Are you physically putting in a kitchen?
Yeah, so we had 4 SKUs for a very long time, and what we're rolling out now is 8 SKUs. And so what we're very focused on being a beverage business first. We're very focused on ensuring that the complexity works within our shops and that we continue to serve our customers with speed, quality, and service. And so that always will come first. And so we're not really finding any complications as we roll out. I think our broistas are loving the food, and we're able to still ensure that we can serve those drinks very quickly as we add food.
So to go back to the expansion question for a moment, when we're talking about adding food, we're talking about also digging in, of course, on your core beverage business and the expansion. What's the biggest sort of bottleneck or roadblock you're coming up against in expansion? Is it finding the locations that you want, the real estate that you want? Is it getting the people that you want? I mean, as you talk about your people being a strength, where are you seeing that friction and how are you going about solving it?
Yeah, we're really not seeing roadblocks as we grow. So we did take some time a couple of years ago to reset, make sure that we had all the market planning tools in place, make sure that we had the teams in place to do everything. But we're really in great shape to continue on that trajectory to hit 2,029 shops in 2029. So feel that we have the people in place. We have 475 operators, which is there are people who sit just above our shops and go and open the new communities. So we're ready from a people perspective. I think as our brand becomes more well known, that developers are very excited to see a Dutch Bros come in. And so all of those things are going incredibly well.
Christine, on Wednesday evening, aired Thursday morning, I had the chance to chat with McDonald's CFO, who said that they had a very successful beverage launch. 1, how are you looking at that competition? And 2, what's been the impact of GLP-1s on your consumers?
Yeah, so we've been in this business since 1992. We grew up in the Pacific Northwest, so competition is certainly nothing new for us. I do think what we're seeing now is a recognition of how big the energy market is. We are the category creator of that energy segment. It's so customized at Dutch Bros. We have it blended, we have it iced, we can make it all different types of flavors. And so I think all of those things are really benefiting us, and others are starting to see just how large and growing this energy market can be. And then as far as GLP-1s go, we are all about customization. We launched protein at the beginning of 2024. We have 15 different sugar-free sauces and syrups. And so thinking of all the different ways that you might want to customize your beverage, we have that for you.
Coming up, Homebuilder confidence sinks in the latest data. The head of the NAHB explains why. That's next on Market Domination. CEOs from the largest U.S. banks all saw their pay jump after a banner 2025. And Yahoo Finance's David Hollerith is here with the breakdown. So David, let's start here. All right, so big bank CEO pay, in your very good article, you know, it surges by $45 million in 2025. Maybe start there, high level. What drove that? Is that performance, David? Is that stock prices? What's going on?
So Josh, it's a little bit of a mix of all of that. So you could say financial and non-financial targets, stock price, earnings performance, and also just these CEOs achieving whatever strategic targets they set out to do. And the compensation is typically decided by the board, specifically the board's HR compensation group committee. And they vary between all these banks. But really the story here is how good of a year 2025 was for Wall Street's biggest banks.
Let's talk about some individual names. Let's put some faces to this, David. So Morgan Stanley's Ted Pick, you point out. Now he saw the biggest jump among rivals, 32% to $45 million for Mr. Pick. Only behind Goldman's David Solomon for the highest annual pay, by the way. Then here comes Charlie Scharf over at Wells Fargo. Annual comp for Charlie, that jumped 28% to $40 million. What explains that one, by the way?
Yeah, right. So Pick, it was his second year as CEO. So you can kind of think of his compensation as starting to a lower point in the group. And then it gets back to what happened last year. The biggest story, along with deregulatory moves by the Trump administration on bank regulation, was really Wall Street firing on all cylinders in an environment that's honestly kind of unusual, where trading has a lot of volatility, and it's positive volatility because the stock market ends up going higher through the year. Then on top of that, it's a good environment for deal making. So Ted Pick really benefited from that. And you also noticed that Goldman Sachs CEO David Solomon, although he didn't have the biggest increase, he had the highest overall total compensation. And then for Scharf, it was more of a story of the regulatory restrictions that were lifted on the bank last year. Wells Fargo, for 6.5 years, was dealing with a pretty onerous growth restriction, and regulators loosened that over the summer. And in addition to that, under Scharf's watch, the bank has had the regulators have lifted a number of consent orders related to those restrictions. So this has been a very tough move to transform the bank, a turnaround effort, if you will, that Scharf really saw, I guess they don't call it this, but you could call it a light switch moment for the bank, where they can actually start to grow their balance sheet. And Wells Fargo actually was able to take some market share gains in investment banking last year, and that was another huge priority for them.
This year, David, I'll end here, with the exception of Goldman, big bank stocks are down, right? But when you listen to the CEOs that you've been talking about here, they're still positive, right? They're still constructive when they talk about 2026.
Right. So to the extent that we heard from all these CEOs last month, things have sort of changed, at least in the stock market, in the last 2 or 3 weeks. But we did hear from Brian Moynihan, Bank of America CEO, and David Solomon, CEO of Goldman, last week at different financial services conferences, and both of them kind of tip their hat to continued optimism for what looks like a good year, another good year for deal making. And investment banking is really one of the details, one of the variables here that defines how good these banks' earnings are going to be. One interesting thing that Solomon did point to is that he highlighted how good the environment looks for M&A and also the possibility for some large-scale IPOs to come later in the year. But he also pointed out that there could be some recalibration similar to what was seen last year in April. Mm-hmm. He didn't say it, but that's the period where there's a huge pause in the deal market, largely as companies were trying to grasp with what it meant with the sweeping tariff rollout. So, factoring in that a lot could happen as did last year, all these CEOs sound, or at least the ones we've heard from so far, sound pretty optimistic about what the pipeline looks like.
All right, it's a great story by you, David. Appreciate it. Thank you.
Thanks.
Well, homebuilder confidence slipping again to start the year. The latest NAHB housing market index falling at 36 in February, signaling more pessimism on homebuilders. For more, we're bringing in now Jim Tobin, CEO of the National Association of Homebuilders. Jim, always great to see you, my friend. So let's just dig right into this. The headline here, we're well below 50. We fall to 36, Jim. That was, it looks like below the estimate. What do you make of this number, Jim? What explains it? Where do we head from here?
Well, we head up from here is my sincere hope, but the reality is we're still mired in this pessimism that we've had now for several months. We've seen the HMI retrench a couple points over the last few months. I think it's really just whether or not the market is going to turn around here. Mortgage rates, which sagged down closer to 6, are now back up at 6.25. And while builders are offering a lot of incentives, whether it's rate buy downs or actual price cuts to get people to the off the sidelines, they're still stuck there. But I will tell you, I'm sitting here in Orlando, Florida. The weather's gorgeous. We're at our international builder show here, and the vibe, there's 100,000 people in town here, and I can tell you everybody's in a good mood. So I feel optimistic about the future, even if the HMI is signaling a little bit of a slowdown.
Why are they optimistic, Jim? Why is the mood there more positive? What are they saying?
Well, for first, I believe it's primarily because right now existing homes are more expensive than a new home. So that means they are seeing some sort of new traffic. The question is whether people are going to get off the sidelines. But I talked to one builder from Missouri who said he had the best January he's had in a couple of years. February shaping up to be the same. So the market is moving slowly. I think it's people realizing that the mortgage rates are going to stay in the 6% range. You might as well get off the sidelines now if you're a credit-worthy borrower and get into home ownership as best you can.
One data point that released, Jim, I thought was interesting today. It said, in terms of pricing, Jim, 36% of builders cutting prices. I think you say your average cut is around 6%. Is that enough to stimulate demand, Jim?
I sure hope so. I think it's more about the rate buy down. I think you're going to find that if companies can buy rates down closer to 5%, heck, even tick into the high 4s, that's really the incentive for people. And that's actually a better deal than just cutting the price of the home, because you can build equity faster, makes that house much more affordable. So I think you've seen maybe a different mix in the incentives away from price cuts and moving towards rate buy downs. Whether it's enough, again, if you're in the market to buy a home or your life situation is dictating that you need to make a move, you're going to go ahead and do that. And whether the action we're hopeful picks up, we're talking to the administration about how we can get the housing market going this spring. So again, optimistic, but whether it's enough, proof is always in the pudding.
Your economist aside here, Jim, is saying, let me read this. The solution for the housing market is the enactment of policies that will bend the construction cost curve and enable additional supply of attainable housing. So what specific policies, Jim, are we talking about here?
First, we're talking about land use. Land is the biggest factor when it comes, and the biggest cost center when it comes to building a home. So we've got to make more land available, and that land has to be affordable for first. Second, we need policies in this country. They're going to talk about encouraging more kids to get trained in the trades, and an immigration policy that has some sanity to it, where we can bring people in this country legally to work and lower our labor costs and reduce cycle costs. And then finally, the regulatory burdens writ large, whether it's permitting fees at the local level or permitting times, or even state and federal regulations that increase the cost of housing. All three factors of those would be a great way to bend that cost curve so we can build housing faster and more affordably.
So, Jim, do you see evidence that we are seeing some of these policies that you've outlined, they're actually getting enacted? Are you seeing movement on federal, state, or local level?
Yeah, I think housing is having its moment. I think you're really starting to see all three levels of government. In fact, here in Orlando at this meeting, we've hosted the American Planning Association as well as the mayors talking about how we can revive America's housing economy. So all levels of government are talking about it. All levels of policymakers are talking about it. There's two bills that are working their way through Congress. In fact, the House passed a bill just last week with over 300 votes. Find me another piece of legislation that's got 300 votes in this critical climate. The Senate's already done their job. Now they're going to marry these two bills together and send it to the president. He signaled that he will sign it. So it is hopeful that we are starting to see everybody moving in the direction of providing more policy stability for housing production.
Final question, Jim. I think you said the 30-year fix is around 6.25. You've got very smart economists on staff. I'm always just curious to hear, 6 months out, 12 months out, Jim, where do you think we're at?
I think we're in the exact same place. We don't predict that the 30-year fixed rate goes below 6% this year. We'll probably see it closer to midpoint in 27. Again, that's just an estimate, but just based on where we are, debt, deficit, the bond market, inflation is still out there, though we had good inflation reading last week. We saw good job numbers last week. So there's reason to be optimistic about the future. We saw that the Trump tax cuts are now fully in effect. The economy is going to start moving along here. But I think at the moment, our prediction is that we're going to stay in this kind of tight trading band in that 6 to 6.25 for the rest of the year.
Jim, as always, great to see you. Thank you, sir.
Josh.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.